Hello, Avila Finance students. I hope everybody had a good week. This week we're going to switch to chapters 3 and 4. So in those chapters, we're going to look at understanding financial statements and cash flows, and also look at financial ratios. So just a little side notes about the class. I was really encouraged about the forum discussion, so just keep that up. I will try to get everything graded by Monday or Tuesday at the latest, but I think I should be able to get everything done by Monday because this is a small cohort. So as I said, I will just continue to post these videos on Sunday for the most part, and try to engage in the forum discussion throughout the week. So let's go ahead and start off with Chapter 3. Chapter 3, when we think about the major statements, you have the income statement, which to me is really just kind of like if you look at a period of time, goes back to basic economics in that these were our total revenues, this was our expenses, and this is net income. Now, there's a lot more in between that to drive those things, but I almost want you to think of the net income as like the soup, if you will, what's left over. And of that soup, the company can decide to pay out some of that soup in the form of dividends to their shareholders. Oftentimes, they do not pay out all that soup. They keep some of it in form of retained earnings. But then the balance sheet, and for a balance sheet, I actually encourage all of you, especially from a personal finance perspective, is you should be tracking what is your net worth over a period of time. How does it change? There's a lot of applications of personal finance to corporate finance. Difference is that you have a limited lifetime. You have to make decisions in that lifetime. You try to make these cash flows and patterns go like this and not like this. Okay, but companies do that same thing too. So consider it. You can go out to Excel and just do a template net worth if you don't track your net worth. But I encourage you to do it. But that's essentially what corporations are looking at in a balance sheet, is they're looking at their assets minus their liabilities, and that is their net worth or equity position. But you have to remember this is book value too, and that makes a big difference compared to market value, and we'll talk about that a little bit more later in class when we look at capital asset pricing models. The statement of cash flows, this one can be a little bit more technical, so just kind of read through it. But I want you to think about, like if you look at your textbook in page 66, where we talk about Coca-Cola, where they said, at 2013, we had 20,268 million. At the end of 2014, they had 21,675 million. There was a change in cash flow of almost 1,407 million. So how did this happen? But what you'll notice with the statement of cash flows, it has to use both like the different statements to look at things, the changes in between. They talk about the operations, the investing, the financing. In fact, when they came up with that change, they said, hey, we had a positive increase in the operations of 85.47. The investing was down 22.62, and the financing was down 48.78. And the net of those together came up with 14.07. So if you go back and you look at page 66 and page 76, you'll see some of those comparisons. Last thing, just to kind of wrap up with that chapter, is the corporate tax rate. And the thing that I just want to stress out of that is, and this applies to personal too, but they talk about like marginal tax rates. If you are, say, like I'm not even quite sure what the tax brackets are now that all the changes in the tax laws, but if you were like in a 15% tax bracket and your income increased this year significantly, you would move to a new bracket. Say it was at 20%. But that doesn't mean that all your income is taxed at 20%. It just means that next increment of income at some benchmark is taxed at that rate. So, but corporations are unique, that they get kind of taxed twice, in the sense that they get the corporate taxes, and then also when any dividends are distributed, those shareholders also get taxed on those as personal income. But those tax laws, they changed under the Trump administration to a degree, and they always seem to be changing over periods of time. So it's just something you have to be cognizant, because sometimes it can impact strategies with financing. Okay, Chapter 4, the financial ratios. So I think how I view financial ratios is it's a measurement, it's a benchmark. How are we doing? We could look at how are we doing in current ratios now? How are we doing compared to our peers? Are our ratios in line with what our peers have? Because Certain industries, like a software company, may not have a lot of physical assets. It's more of an idea. But something like a hotel or airlines, they have the buildings, they have the planes, so they may have a different structure of assets. So that's something to keep in mind. But the major categories they talked about in this chapter, it was one, liquidity. I want you to think of liquidity as the ability to convert to cash without loss of value. So, how quickly can I cover short-term expenses? Like an example of current assets over current liabilities. Cash, you have to remember too, I want you to think about it this way. It's good to have, but it's also an opportunity cost, because if you have too much cash on hand, from an investor's perspective, you're not really earning the required rate of return. I think years ago, probably 5+ years ago, Microsoft decided just to pay out a huge cash dividend because they really didn't have enough investment opportunities out there worthwhile. So they did the right thing, and they just gave the shares, not the cash, back to their investors because they couldn't find anything in the market that was of value to give them a better return. It's always good to have for a rainy day fund, but from a corporation perspective, it's a little bit different. And it's same as personal, if you have so much money you're tied up in cash, it's the opportunity cost, as with inflation that we're starting to see. So they generally recommend to have about at least 3 to 6 months of cash on hand for an individual, just in case if you were to lose your job or something were to happen. That's hard for a lot of us, but, we'll tie into concepts later that you're better off having some access to cash, a line of credit or something like that if something does happen, because when things do go bad, and same for corporations too, nobody wants to give you money. They also talk about, like return on assets. You look at some of those, like, we can think about operating profit to total assets, how much, profit is generated for what I have. The financing, for example, how do I raise money, like a debt to equity? Like I said, like a software companies might be very equity based in stocks. Other companies may have a lot more bonds on their book to help finance them. They also mention about like good return on investment. For example, this might be net income to common equity. How are you doing for those of your investors? And then last, they talk about like shareholder value. A common one is like a PE ratio, so the price to earnings per share. So like I own some what's called EVRG stock. It used to be Kansas City Power and Light. It merged with Kansas, Missouri, so it's in one of my retirement portfolios. But the earnings per share, I want you to think of like, again, just the soup divided by the number of shares outstanding. So if the price of EVGR is at like $50 and they're making like a $3 earnings per share, then it's just that ratio of 50/3. So it just kind of gives you an alignment to where they stand in the market. So if you have a pretty high PE ratio, it probably says that most of the market truly value that company and they expect good things about it. So, and at the end, they just briefly mentioned EVA. It's kind of a economic value added. It's a harbinger of things to come. We start to look at internal rate of return and net present value. But EVA can also be used as something to help me evaluate my performance, or whether I take on a project. When I was at Sprint, we used to do it for the cell phone towers. Decide, hey, is it worth to put a cell phone tower in this area? How many lines and how many hits would it get? Is it worth that return on the investment? So, well, that's it for this week. So I said I'll try to jump in the forum discussion, but have a great week, and I look forward to talking to you online. Take care.